Hey, what's up guys? Thanks for tuning in. I'm going to do a quick video here on the general overview of the economic situation here in Canada. As you've probably heard or been aware of, the housing prices here have just gone through the roof. So just going to do a little video kind of outlining what's going on here, showing you some charts that just kind of help outline the current situation. So this first chart here is showing the average house price in Canada. As you can see, we're just under 400, but it only goes up to 2011. So now we're sitting around $500,000 for the average home. Um, Pretty high. Here's another chart showing the average wage. So starting in 1991, the average wage was just under $14 an hour, and we're only at $24 an hour now. So that's an increase of only 58% since 1990. Whereas house prices have gone from they were around 150,000 back in 1990, and they've gone all the way up to 500,000. So that's an increase of 330%. So you look at that, when your wages haven't gone up even 100%, they're just like 60% increase, and then the average home has gone up 330%. That puts a lot of stress on the household and trying to make those payments. How have we been doing that? Well, we've been doing it by borrowing a lot of money from the banks. Here's a chart showing the household debt to disposable income ratio. So back in 1990, we were sitting around 90, which is quite a low number compared to where we're at now. We're sitting just under 180 now. So household debt has just been climbing out of control here in Canada. Here's a chart showing, this is US compared to Canada. So this is the financial crisis of 2008. So a lot of Americans were forced to start liquidating their homes and paying off some of their credit card debt. And you saw that the debt levels come down there. So they're at a more manageable level now. Whereas Canadians just continued to borrow and the rates just kept going up. The debt levels kept going up. So not a good situation here in Canada. A lot of borrowed money going on. This is what happened to house prices. So after 2008, the Americans were kind of called on all their debt and the banks wanted the money back, and a lot of people were forced to liquidate their homes and sell a lot of their assets. So what we saw there was just a lot of houses all coming on the market at once and really driving down that average cost of the American home. So yeah, we dropped from, I think, what were we here? So we were around just under 300,000 at the peak, and then they dropped as low as 200,000. So that's, 30% drop, quite a big drop, and they've been slowly coming up a little bit since. Whereas Canada has just been climbing and climbing ever since. This only goes to 2014, so we're all the way up here somewhere at $500,000 for your average home. So most likely Canadians are going to be seeing a pretty sharp correction here just because it's all on borrowed money, and as soon as the banks start raising interest rates, the reality is Canadians don't have any savings and it's all on borrowed money, so we're highly at the mercy of interest rates. Here's a chart just showing that Canada is actually leading the world in the amount of household debt. So we currently carry the highest amount of household debt in the world out of all the advanced economies. Here you can see the US is fourth, but Canada number one. So not looking good there, Canadians. You might want to start paying down some of your debt and kind of getting ready for higher interest rates here. Here's a chart just showing Canadian household savings. So it only goes back to 1981. As you can see, it's just come way down. So Canadians really don't have savings at the moment. We really don't have much in general. A lot of people here are just going off borrowed money. Here's a chart just outlining the historical interest rates. So you can see why a lot of Canadians have borrowed money. Right around 2010, we were faced with a big market correction here as well. So what the banks in Canada did is they made money really affordable to borrow and help, keep the economy afloat and really prop it up with cheap money. So what they did is they dropped rates lower than we've ever seen before in Canadian history. Lending rates for consumers all the way down to under 3% here. So very, very low. And we've sat at that level ever since. They just really haven't been able to raise rates without, affecting the economy and having things crash essentially. So if we zoom in here in the last 5 years, though, you will see that just in the end of last year, the banks really started jacking up rates. The average level or the average interest rate since 1960 has been 7.3. So we're only at 3.5% now. So if we go to a more average level of 7%, we're going to double from the rate we're currently seeing. So that's going to put a lot of stress onto these massive mortgages. $500,000 for an entry-level home here in Canada, that's going to put a huge stress. That's a lot of money. Seeing interest rates, potentially double from here. And, if you look at some of these other points in time where we saw, 22% in the mid 80s, 15% in the early 90s, we could easily return up to some of these more average levels. So as you can see from 1970s, we've kind of bounced between 5 and 10%, and a few times we skyrocketed all the way up to 20% here. So we've never seen levels this low. Probably not going to sustain too long, but the banks are pretty desperate here, so they might keep prices or interest rates down, which isn't necessarily a good thing. It does help our export market, but it doesn't help the Canadian dollar. Basically, it's devaluing the dollar on the world market, because money is just, you don't really have to work for it here. You can just go and borrow it for next to nothing from the bank. So when you're looking in the world market, a lot of other countries won't really value your currency too much if you're just all borrowing money and you're not really contributing on the world market to earn that money. So I'll show you how that's devaluing the Canadian dollar here. Here's a chart. This is US to Canadian. So as you can see, we're getting up near these pretty high levels again. We're $1.30 Canadian for $1 US. So we're almost back at those 2016 levels where we were paying over $1.40 for a single American dollar. So again, we were all the way down. We were actually over par 2011 here, and we've just been losing value ever since. And a lot of that is from just having interest rates so low. You can see here, just starting right around 2011, and just taking on all this debt, and it's really devaluing the Canadian currency. Another example of that is just gold, another international asset here. So comparing the Canadian dollar to that, you can see that the price has just been going up. And so since 2011 here, we've just been climbing back up as the Canadian dollar devalues. So really not a good thing having these extremely low interest rates. That's also helping to push up the price of homes by devaluing the dollar and making money so easily accessible to all these people. So as a lot of these first-time homeowners look to jump in to the real estate market, there's a lot of people in Canada that believe prices aren't going to correct, they're going to keep going up. It's quite unlikely. There's a lot of money and a lot of people betting against the Canadian real estate market. It's pretty much the biggest bubble we've ever seen here. So the one thing that happens is once homes start to lose their value, there's a lot of international money here kind of putting their money in real estate. There's a lot of money laundering going on in Vancouver and whatnot by hiding their money in Canadian real estate. So that's been a good position for them to, a good place for them to hide their money. Well, real estate's just been going up and up at this exponential rate. But when people start to liquidate, it really, it all comes crumbling down at once, because a lot of the foreign investment will start to pull out and look for better places to to put their money. So really not a good time if you're looking to get into Canadian real estate. I would highly recommend holding off on that and just waiting for this correction. Hopefully you're not too overextended as well. This is really a good time to start paying down your debt as we start to see interest rates creep up. So yeah, really a good time while we still have a booming economy with all this cheap money. You know, really put your head down and pay off some of your debt. You don't want to be holding, you know, $500,000 in debt once the rates start to go up. We saw that in the early 80s, and it was really an ugly situation. You know, people had been paying down mortgages for 20 years, and they were forced to kind of sell their home for $1. There's stories of that, just like, take over my mortgage. I can't afford the payments. So things could get really ugly. Hopefully you haven't overextended yourself. You know, if you've bought in the last 5-10 years and you know, you have a good stable job and you're not carrying too much debt, I'm sure you'll be fine. In the long run, it's true, real estate does always hold its value and go up. The general trend line is going up all the time, but we are definitely up at this crazy peak, and it's most likely a bubble. Most things are pointing to that, especially the you know, when we look at the Canadian household debt to earning ratio, it's just at these unsustainable levels. So we're just below 180, and as you can see here, the U.S. They were, you know, what were they? They were at let's see here. They were around 130, and they couldn't support the debt load. And Canadians now we're like just below 180. So we're really carrying a ton of debt. Not a good thing. And as soon as rates continue to climb here, that's really going to force a lot of people into trying to pay off their debt quicker, because interest rates or their interest payments are going to get so high that it's just going to become unsustainable for most Canadians. So yeah, thanks for tuning in. Please give us the thumbs up if you liked the video. Feel free to share and follow us for future videos. I really appreciate you guys tuning in and listening to what I had to say. Have a great day.